Okay, so imagine this. You're at a family dinner. Aunt's son has just started his first job. Someone brings up the stock market, and your uncle, you know exactly which uncle I'm talking about, leans back in his chair, very confidently says, Hey, put 1 crore, sit back, and money will keep coming monthly. 1 crore, sit back. Money just appears. And here's the thing, nobody at that table questions it because 1 crore sounds like enough. It sounds like the number where life becomes easy, where you stop worrying, where you just receive dividends. But does it? Does 1 crore rupees actually deliver the kind of passive income your uncle is imagining? Today we are going to do the actual math. No vague, it depends, no hand waving. Real numbers, real stocks, real tax implications. And I promise you, by the end of this video, you are going to look at that 1 crore figure very differently. My name is Rohan and I spend way too much time thinking about dividend investing and passive income in the Indian market. If you're someone who has been told that a big enough lump sum basically solves your financial life, but something in the back of your head keeps asking, wait, is that actually true? Make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we are going to stress test one of the most beloved myths in Indian personal finance. Let's start with what most people picture when they say, I'll live off dividends. They imagine parking 1 crore rupees somewhere good, maybe blue chip stocks, maybe mutual funds, and getting, say, 50,000 to 80,000 rupees every month. Nice round number. Covers rent, groceries, maybe a trip to Coorg once a year. Here's what they're actually going to get. The Nifty 50, the benchmark index of India's 50 largest companies, has an average dividend yield of roughly 1.2 to 1.5% per year as of early 2026. That's the weighted average. That's what investing in good Indian companies gets you on average. So let's do the math no one does at the dinner table. 1 crore rupees multiplied by 1.3% equals 1,30,000 rupees per year. Divide that by 12. 10,833 rupees per month. I'll let that sit for a second. 10,833 rupees per month from 1 crore rupees. That doesn't even cover a decent 2 BHK rent in Pune, forget Mumbai. The average monthly household expenditure for an urban Indian family in 2025 to 26 is estimated at around 35,000 to 45,000 rupees. And that's a conservative middle class figure. You'd be covering barely 25% of that with your 1 crore dividend dream. Now you might be thinking, Rohan, obviously I won't invest in an index. I'll pick high dividend stocks. Valid. Smart even. Let's go there. Okay, so here's what the actual high dividend landscape looks like in India right now, in 2026. The genuinely high yield stocks, the ones that financial Twitter loves to screenshot, include names like Coal India, dividend yield hovering around 6 to 7%, IOC, Indian Oil Corporation, anticipated yield above 8% in 2026, Vedanta Limited, consistently 6 to 7%, sometimes higher, HPCL, Hindustan Petroleum, competitive yields in the 5 to 6% range. Castrol India, reliably around 6%. So let's be generous. Let's say you're a smart investor. You build a concentrated portfolio of these high-yield PSU and energy stocks and you manage to average 6% yield on your 1 crore. 1 crore rupees multiplied by 6% equals 6 lakh rupees per year. Divide that by 12. 50,000 rupees per month. Okay, now we are talking. That starts to sound like your uncle's promise, right? But, and this is where it gets really interesting, we haven't talked about the two things that will absolutely eat into that number. The first one is tax. The second one is concentration risk. Let's destroy the tax myth first. Here's what most people don't realize. Since the 2020 Union Budget, dividends in India are taxed at your income tax slab rate. Not a flat rate, not a special passive income rate. Your slab, your rate. And just so you know this isn't theoretical, companies are already deducting 10% TDS on dividends the moment they exceed 5,000 rupees in a financial year. So the government is collecting before the money even hits your account. You then reconcile the rest at the time of filing based on your actual slab rate. So if you're getting 6 lakh rupees per year in dividends and you have any other income on top of that, a rental property, a small business, freelance work, a spouse's income in some HUF situations, you could easily land in the 20% or even 30% tax bracket. Let's use 20% for someone in a moderate income situation. 6 lakh rupees multiplied by 20% equals 1 lakh 20,000 rupees goes to the government. Net dividend income 4,80,000 rupees per year, or 40,000 rupees per month, from 1 crore rupees. And we haven't even gotten to the second problem yet. Look, I need to be real with you for a minute. Those 6 to 8% dividend yields are coming almost entirely from PSU stocks, public sector undertakings. Coal India, IOC, HPCL, Vedanta, these are government-linked or commodity-heavy companies. And here's the thing about PSU dividends. They're wonderful in good years and extremely unpredictable in bad ones. The Indian government, which often controls payout decisions at these companies, sometimes cuts dividends, delays them, or redirects cash towards capex during rough quarters. Vedanta, for example, has had years of spectacular dividends, and it's also a company that carries significant debt. Its dividend history, while impressive on average, is lumpy, not smooth monthly income. Lumpy. And here's the part that really doesn't get talked about enough: corpus erosion. A 7% dividend yield sounds fantastic, but if the stock price drops 20%, which PSU and commodity stocks absolutely do during rough cycles, your 1 crore rupees just became 80 lakh rupees. That's 7% yield. It means nothing. Your income is the same number of rupees, but the wealth underneath it quietly evaporated. High yield can very easily be a mask over capital depreciation, and if you're not watching the underlying business quality, you won't notice until it's too late. Coal India is better, more consistent, but you're essentially betting your entire passive income on the future of coal in a country that is aggressively transitioning to renewables. The long-term structural risk is real. This isn't me saying don't invest in these companies. I invest in some of them myself, but if your entire retirement plan is sitting in a handful of high-yield PSUs, that's not diversification. That's a concentrated bet dressed up in a passive income costume. Here's something I find genuinely fascinating about how people think about this. When someone imagines living off dividends, they almost always underestimate how much they actually need. And there's a psychological reason for it. The number 1 crore feels so large that it tricks our brain into thinking the problem is solved. Psychologists call this number anchoring. We anchor to a figure that sounds impressive, and we stop questioning whether it's actually sufficient. Think about it this way. If I told you I have a fixed deposit that pays me 10,000 rupees per month, you'd immediately say, that's not enough, man. But if I said I have 1 crore rupees invested in the stock market, you'd nod respectfully. Same income, completely different emotional reaction, because 1 crore sounds like an arrival point. It's not. In today's India, with inflation running at 4.5 to 5.5% annually, even in the post-COVID period, with urban cost of living increasing faster than CPI in cities like Bengaluru, Hyderabad, and Mumbai, 10,000 to 40,000 rupees per month from passive income is not financial freedom. It's a head start, an important head start, but it's not the finish line.
Okay, let's flip the question. Instead of asking what does 1 crore pay, let's ask what corpus do you actually need to generate meaningful passive dividend income? Let's define meaningful as 75,000 rupees per month after tax. That's 9 lakh rupees per year post-tax, which covers a comfortable urban Indian lifestyle without being extravagant. Working backwards. If you're in the 20% tax bracket, you need to earn 11 lakh 25,000 rupees in gross dividends to keep 9 lakh rupees after tax. At a realistic, diversified dividend yield of 4%, not chasing the riskiest names, not sticking to just the Nifty average, but a thoughtful blended portfolio, you need 11 lakh 25,000 rupees divided by 4% equals 2 crore 81 lakh 25,000 rupees. That's close to 3 crore rupees. Not 1 crore, 3 crore. At 6% yield, aggressive but possible with PSU concentration, you still need 1.875 crore rupees. That's the range. 1.9 crore rupees to 3 crore rupees for genuinely comfortable tax-adjusted dividend income of 75,000 rupees per month. Now, does this mean 1 crore is useless? Absolutely not. It means you need to understand what 1 crore actually is in the dividend journey. Not the destination, but a very strong foundation. Here's the thing. Most Indian dividend investors make the same 3 mistakes, and if you avoid these, you'll be miles ahead. Mistake number 1. Chasing yield instead of building yield. There's a massive difference between a company that currently has a 7% yield because its stock price has crashed and a company that has grown its dividend consistently for 8 years. The second one is called a dividend compounder, and it's the one you actually want. Look at companies like ITC, Infosys, and TCS. Their current yields aren't breathtaking, maybe 2 to 3.5% in 2026, but their dividend per share has grown steadily year after year. You buy them today at 2.5% yield on your cost price. 5 years later, your yield on cost might be 5 or 6% because the dividend has grown even as the stock price has risen. This is how wealth is actually built through dividends, not by finding the highest yield today, but by finding the highest growing yield over time. Mistake number 2. Ignoring the dividend frequency problem. Most Indian companies pay dividends once or twice a year. This is critical. Your passive income might arrive in two lumpy chunks, say October and March, and then nothing for months. That is not a salary replacement. That's an annual bonus structure. If you want monthly-ish income, you need to either build a portfolio of companies with staggered dividend dates, which require serious research and tracking. Use dividend-oriented mutual funds or ETFs which smooth out the lumps but take a small cut. Combine dividend stocks with instruments like REIT distributions. Real estate investment trusts now have a decent presence in India with Embassy Office Parks, Nexus Malls REIT, and Mindspace, which often distribute quarterly. Mistake number 3. Not reinvesting when you don't need the income yet. This is the one that kills me. So many young investors, people in their 30s who have 20 to 25 working years ahead of them, start building dividend portfolios and immediately spend every rupee of dividend income they receive. I get it. It feels great. Look, I made 8,000 rupees this quarter just sitting here. But here's what you're giving up. If you reinvest 8,000 rupees in dividend income back into the same stocks, what's called a DIRP strategy, dividend reinvestment plan, and you do that for 15 years at an average 12% total return, that 8,000 rupees becomes 43,000 rupees per quarter by the time you actually need the income. Compounding is violently patient. It rewards people who can delay gratification by a ridiculous amount. So, what does actually building this look like step by step for a normal person in India in 2026? Step 1. Know your number. Calculate your actual monthly expense target, add 20% as a buffer for inflation and lifestyle creep, then gross it up for tax. That's your income target. Work backwards to find your corpus goal. Step 2. Build the core with dividend compounders. Allocate 50 to 60% of your dividend portfolio to companies with long histories of growing dividends. Think ITC, Infosys, HDFC Bank, Tata Consultancy Services. Lower current yield but reliable and growing. Step 3. Add yield boosters but cap them. Allocate 25 to 30% to higher yield names. Coal India, IOC, Power Finance Corporation. Get your blended yield up, but don't over-concentrate. No single stock should be more than 10% of your dividend portfolio. Step 4. Add REITs for quarterly income. 5 to 10% in Indian REITs gives you quarterly distributions and real estate exposure. Embassy Office Parks REIT, for example, has been distributing consistently. It's not spectacular, but it's regular. Step 5. Track your yield on cost, not current yield. As your portfolio grows and dividends compound, focus on what you're earning relative to what you originally invested, your yield on cost. This number, over time, is your real scorecard. Now you might be thinking, Rohan, this is overwhelming. I just wanted to know if 1 crore was enough. I hear you, and here's my honest answer. 1 crore is not enough to replace a full income through dividends. But 1 crore invested smartly and grown over 10 to 15 years through reinvestment and continued contributions can absolutely become the 3 crore corpus that does generate meaningful passive income. The problem is not your starting point. The problem is the narrative we've all inherited. That there's a magic number where you can stop thinking, stop contributing, stop engaging with your money, and just collect checks. That's not how wealth works. Wealth is not a trophy you put on a shelf. It's a living, breathing system that requires intentional design. The people who genuinely live off dividend income, the ones who've done it for real, didn't get there by finding the one magic stock.
They got there by building a portfolio patiently, reinvesting religiously, diversifying thoughtfully, and letting compounding do its silent, brutal, magnificent work. So, here's what most people don't realize. The process of building towards dividend income itself is transformative. It changes how you think about money. You stop seeing income as something that only comes from your salary. You start seeing capital as something that can work while you sleep. And once that mental shift happens, once you truly internalize that, the number you're building towards stops feeling impossible. Because you understand the math, you're playing the right game. So, let's recap what we covered today. 1 crore at the Nifty average dividend yield generates roughly 10,000 to 11,000 rupees before tax. Even with aggressive high yield positioning, you're looking at 30,000 to 40,000 rupees after tax, which is real money, but not the full income replacement story you've been sold. To genuinely replace a 75,000 rupees monthly lifestyle, you need a corpus closer to 2 to 3 crore rupees invested across a diversified, quality dividend portfolio. The strategy? Dividend compounders as your core, yield boosters as your supplement, REITs for regularity, reinvestment until you actually need the income, and a clear-eyed understanding of your tax situation. 1 crore is not the finish line. It's the best starting gun you'll ever fire. If this video made you rethink even one assumption about passive income, drop a comment below. Tell me where your thinking shifted. I genuinely read every single one. Subscribe if you haven't already, hit the bell so you don't miss it, and I'll see you in the next one.